Can you imagine this? It's 2023 or 2024, and you finally saved enough money to buy your first house. You're so excited, but then you see the news and find out that the housing market is crashing. Your heart sinks as you realize that your dream of owning a home may not be possible after all. This is a scenario that many people fear when they're looking to buy a house, and it has been a nightmare for many over the past decade. However, with the market being as crazy as it is now, this fear is even more prominent in people's minds. If you're in this situation, imagine your monthly payment is $2,800 and your gross annual income is around $100,000. This means you're bringing in about $8,333 each month before taxes. Since you don't have any debt to pay off, your lender approved you for up to $3,750 per month. At first, you were relieved that you bought a house for less than what you were approved for. But then reality starts to set in. Your net income is only around $6,249 per month after taxes, which means that your monthly payment now makes up 45% of your take-home pay. That's almost half of what you're bringing home every month. You start to realize that you probably stretched yourself too thin with this purchase, but you have hope that you can just refinance when the interest rates go down. After all, part of your monthly payment is so high because you have a 7 to 8% interest rate on your mortgage, which was the going rate at the time of your house purchase. Fast forward 6 months, and things are starting to feel a bit strange. You're managing to make your monthly payment, but it's a real stretch, and you can't help but think that maybe you made a mistake by buying this house. But then you start to see something interesting happening. Houses in your neighborhood and other neighborhoods nearby stay on the market longer, with more open houses and for sale signs popping up everywhere. And then you realize that it's probably because interest rates are starting to drop, making it easier for people to afford homes. Suddenly, your decision to buy a house with a high interest rate doesn't seem so wise anymore. You can only hope that the trend continues and that eventually you'll be able to refinance and reduce your monthly payments. But until then, you'll have to keep a close eye on the market and hope for the best. Please take 2 seconds to help me out and hit the like and subscribe if you're enjoying the video so far. Each like and subscribe helps support this channel and keep us motivated to keep making you great content. Thank you. Now, back to what I was saying. Have you ever wondered why there seems to be a sudden influx of houses on the market? It may not have crossed your mind, but for those aware of the current trend, it's clear that something is happening. When the supply of houses increases and the demand drops, prices inevitably begin to decline. But unlike stocks, where numbers change in real time, the housing market operates differently. The value of a house is not determined by a ticker, but rather by what someone is willing to pay for it. When a homeowner puts their house up for sale, they set a price based on their perceived value. However, if the house sits on the market for a month or two without any offers, it's clear that the initial asking price was inaccurate. This is when the real adjustment begins. The homeowner may reduce the price by $20,000, then another $5,000, and so on, until they finally accept an offer of $350,000, a significant drop from their original asking price of $500,000. This sale then becomes the new benchmark for other houses in the neighborhood. If a similar house is put up for sale, the owner may be forced to lower their price as well to compete. As more and more houses are sold at lower prices, a new standard for the market value of homes is set. This trend can continue until, eventually, houses are selling for much less than their initial asking price. It's a domino effect that can greatly impact the market. In this particular scenario, one can encounter a very unpleasant situation. Imagine someone decides to sell their house and puts it on the market. However, for some reason, the house stays on the market for a significantly longer period of time than expected. Sometimes, these houses never get sold and are left on the market indefinitely until something unexpected happens. Alternatively, the house may eventually get sold at a significantly lower price than initially expected due to various reasons such as low market demand or other external factors. Now, let's fast forward a year after someone has successfully purchased a house. Interestingly, they've been noticing similar houses being put up for sale, but this time they're being sold for a much lower price than what the buyer paid for theirs. This can be quite concerning for them because they have invested a large sum of money, let's say $500,000, and now these houses are selling for only $250,000 to $300,000. In other words, they're officially underwater in terms of their investment. This has happened before, specifically around the years 2007 and 2008. If you were to look back at the years 2003 and 2004, it would seem like prices were relatively stable. However, things took a turn for the worse in the following years. This increase was not natural and had artificial factors that caused it. It's difficult to pinpoint exactly when this artificial increase began, as it could have started earlier than we think. But one thing is certain, without this artificial inflation, prices would have remained more reasonable. So now the question remains, how long will it be before prices return to their pre-inflation levels? The answer is uncertain and hypothetical. Only time will tell when the market will stabilize again, but until then, consumers can expect lower prices or at least a decrease from the inflated rates. Currently, the housing market is quite unstable. Prices are skyrocketing and there's no end in sight. However, experts predict that a correction will soon bring down the prices to a more reasonable range. This means that houses selling for $520,000 could drop to around $300,000. This may not be good news for those who have recently bought a house at a higher price, as they'll see a significant decrease in value. But for those patiently waiting to enter the housing market, this could be their chance to finally afford a home. This correction may not happen immediately, and prices could take some time to stabilize. However, if it does occur, it could provide some relief for potential buyers who've been struggling to keep up with soaring prices. But what does this mean for homeowners? If you've already purchased a home and the correction happens within the first year of living in it, you may find yourself underwater. This means your house will be worth less than what you paid. It's definitely not an ideal situation, but it's something to keep in mind. Two possible scenarios could occur here. First, there may be an increase in foreclosures as some people choose to abandon their homes entirely. This happened in the past and resulted in further reductions in home prices. There are two reasons why this might happen again. The first reason is that people who bought a home within the last 2 to 3 years are holding on to it tightly. They can do so because they can afford their monthly mortgage payments. This is due to the fact that they were able to secure a loan with a low interest rate of 2 to 4%. Additionally, they purchased their home at a reasonable price range, making their monthly payments very affordable. As a result, these homeowners have no reason or desire to let go of their homes, even during tough economic times. The second reason is that struggling homeowners may simply choose to walk away from their homes. This could be due to job loss, financial difficulties, or other personal reasons. As a result, these abandoned homes may end up in foreclosure and further contribute to the decrease in home prices. A certain group of individuals may face the possibility of losing their homes, those at risk of foreclosure. However, this situation does not arise often unless a major event or crisis affects their lives. Generally, people who have purchased their homes within the last year or so are more susceptible to this risk. This was particularly evident from 2020 to 2022, when there was a surge in home buyers. However, from 2022 to 2023, the demand for homes decreased significantly, resulting in fewer people buying homes compared to previous years. This shift in the real estate market has caused some concern about foreclosure rates. There are many reasons why people may be at risk of foreclosure. A common reason is the decrease in demand for homes, as mentioned earlier. With fewer buyers in the market, homeowners have fewer opportunities to sell their homes and cover their mortgage payments if they face financial difficulties. This can lead to foreclosure if they cannot make their loan payments. Unlike in the past, banks now have various programs and resources available to assist homeowners struggling to make their mortgage payments. These can include loan modification programs and other forms of assistance that aim to help homeowners keep their homes and avoid foreclosure. This was not always the case. These types of programs were not as prevalent before 2009 to 2012. As a result, banks may be more equipped to work with homeowners and find a solution other than foreclosure. Many people believe that the market is going to crash and burn. If that happens, it'll further drive down prices and result in an increase in short sales and foreclosures. This possibility may make you consider refinancing a year later because your monthly payments could become unmanageable. However, it's important to remember that these predictions are not always accurate. The market can be unpredictable, and it's difficult to foresee the future. It's always best to do your research and make decisions based on your circumstances rather than relying solely on other people's opinions. Additionally, refinancing may not always be the best option. It's important to consider the costs associated with refinancing and whether it will benefit you in the long run. To refinance your house, you need equity. It's not as simple as waving a magic wand and getting a new mortgage. Refinancing becomes challenging if your house is currently worth less than the amount you bought it for. You have two options: either come up with the cash to cover the difference or wait until your house appreciates in value. This is why it's crucial to consider the interest rate you'll be getting when buying a house. The rate you lock in today will stick with you for the next 30 years. So think about it carefully. If the idea of having the same rate for such a long period scares you, then perhaps it's best not to buy right now. Some people believe that once they buy a house, that it's the house they'll be in for the rest of their lives. But unfortunately, that's not the reality of the situation for many. No one knows what will happen in the future, so it's better to be prepared and have a plan. In cases where you can't refinance your home due to market conditions, you'll have to accept the situation and find ways to make your mortgage payments. While you may see others around you selling their houses or facing foreclosure, it's important not to compare yourself to them. Everyone's circumstances are different, and focusing on your financial situation is essential. Assuming that you somehow manage to retain possession of your house, it will soon become evident that many other houses in your area are being sold at significantly lower prices. With every home on sale, you feel anxious and reluctant to even consider the price, knowing that you owe more than what the property is currently worth. You hold on to your monthly payment for dear life, hoping that the bank will offer some sort of program to lower your interest rate or modify your loan terms just so you can continue living in your house. At this point, banks usually start releasing down payment assistance programs and first-time homebuyer programs with reduced rates in an attempt to boost the housing market. However, these efforts may have a negative impact on other markets. It's uncertain if this phase, lasting for about 2 to 4 years, will end up being flat or show a slight increase in the housing market. Looking at past data, there was a gradual incline during that time period before reaching a steady state. However, since we're currently dealing with a different market and government, predicting how things will unfold is difficult. There are two paths we can take here, just like before. One option is to follow the same pattern as we did previously. The other route is to consider the possibility of a market crash, which has been generating a lot of buzz lately. It's not surprising that many people may feel inclined to jump in and buy now, especially those who missed out on previous opportunities. After all, during those times, minimal income, fewer jobs, and no asset loans were available. However, what's worth noting is that this situation may not last long. In fact, it could either result in a quick bounce back up or a slow and gradual build-up over time. Surviving in the constantly fluctuating real estate market is no easy feat. With property values skyrocketing and housing inventory at an all-time low, it can be daunting to even think about buying a new home. However, there are easy ways to navigate these ups and downs. One of the most crucial aspects of being able to afford a house is having a realistic budget in place. It's important not to stretch yourself too thin by buying a home way out of your price range. Instead, aim to purchase a property between 20 to 30% of your combined household net income. This way, you can ensure that your monthly payments are manageable and won't become a financial burden in the long run. Seeing houses sold for much less than their actual worth can be disheartening. Hopefully, you will always be able to afford your monthly payments, and that's what truly matters. It may not be ideal, but with the right budget, you can make the most of your current situation. Allocating 20 to 30% of your income towards a mortgage may appear challenging at first. Nevertheless, this challenge could serve as an indication for you to initiate preparations now rather than hastily committing to the purchase of a new home or exploring new builds. Take this as an opportunity to save up and plan for the future so that you're ready to make your move when the market stabilizes. It's all about being patient and making smart decisions in times of uncertainty. Thanks for watching, and please make sure you subscribe if you enjoyed the video and leave a comment below.